And I'm a trading services manager with Charles Schwab out here in California. With me today on the other side of the world is Mike Briscoff, fellow chartered market technician, my friend, trading colleague, and regional investment strategist for the New York City area, Mike Briscoff. Morning, Mike.
Good afternoon, Lee. How are you doing?
Oh, pretty good, pretty good. It's going to rain here tomorrow, but today it's a fine day. All right, let's get to the good stuff. But before we can, usual disclosures, we want to hear from you. Send in your questions in the Q&A functionality underneath the presentation window. Your questions are private, want to be seen by Mike and myself. We'll keep our eye on them to make it as interactive as possible. But we can't always get to all questions due to the ever-increasing number of people on these sessions. We also have our usual written disclosures. We are required to show everything Mike and I talk about should be considered as educational and informational in nature only. Nothing's a recommendation. Any expressions of opinion that either of us make could change at any time based on market condition. We look at a lot of charts, but we do not recommend the use of technical analysis by any means as your sole method of investment research. We look at ETFs and ETNs. We're not recommending any ETFs or ETNs, but we do show them to look at sectors and different areas of the market. If you plan on trading them, though, you should read a prospectus. We also look at futures contracts. If you're going to trade those, do read the risk disclosure document for futures and options. And what I thought I would do first is show you how to get the heat map we show every time. Everybody's been asking how to do that, so we're just going to do that. We are going to just right-click in Street Smart Edge. We are going to go over to schwab.com and just show you the heat map here. We have a lot of new people on. So you go to research, you go to futures, and then you hit the button for heat map, and now you get a nice viewpoint of what's going on in the different markets. So we've got that up there. Let's start reviewing the news, and Mike, if I missed anything, just interrupt me and fill in. So economic data, okay, so economic data was mixed overnight. German retail sales beat estimates. They were still down though, down 5.3%, but the estimates were almost double that. Also, Japanese industrial production and retail sales both missed expectations. Remember though, they are thinking about floating $1 trillion of stimulus over there. In other words, 100 trillion yen. Domestically, the market is still waiting for the president's press conference on China. They haven't set, as far as I know, they still haven't set the time for that. That's what caused the swoon in the market yesterday afternoon, and it's continuing today. There are potential two actions he could take. He could remove any preferential tariff treatment for Hong Kong and treat it just like the rest of China from a trade standpoint, or he could announce sanctions on Chinese officials for the Hong Kong bill and also for the human rights abuses against the Uyghur Muslim minority. And as you know, that's been a priority for the House of Representatives. Depending on the details, here's what I'm hearing out there on the trading community about how the market might react depending on what he does. If only one of these actions is taken, markets will probably shrug it off. If both measures are enacted, though, that will probably extend the declines we saw late yesterday, and I think we're getting some of that today. Actually, maybe they're thinking they're going to do both. But anyway, we don't really need another round of trade tensions with the Chinese, but we'll have to see what's going to happen there. And the worst possible case is he does both of those things and then the Chinese retaliate in a tit-for-tat way like they did last summer, right, Mike?
Not something that the market needs right now, Lee. Not at all. Not at all.
Yeah. Also in the mix, Chinese foreign ministry rejected President Trump's offer to mediate China's border dispute with India. So, I mean, that's not a good harbinger of what they might do if he starts slapping sanctions on there. In domestic economic news, personal income in April surged 10.5%. They were actually looking for a drop. Apparently, the receipt of these economic recovery payments authorized by Congress pushed that number way up. However, personal spending decreased 13.6%. So basically, people are saving. That's what's going on. The saving percentage skyrocketed to 33%. That's a lot of pent-up spending potential. On the other hand, so that's the positive. The negative, though, is that it also might reflect an increased propensity to save money because everybody thinks the recovery is going to be weaker and take longer. We just had one of our clients say that the press conference is now scheduled for 2 p.m. your time.
2 p.m. Eastern, it looks like.
Yeah, just came out, I guess. Thank you very much for that. Okay, also there's really no inflation. We had the PCE core price index. That's the one the Fed follows. It dropped, so there's no inflation out there, at least at the moment. Okay, let's move on here and start taking a look at some chit chat from the Federal Reserve Chairman speaking to a group at Princeton University, and he basically said that they are going to roll out their long-awaited program to lend to small and medium businesses over the next few days. So that was the main headline from that. Just keep in mind that Main Street lending facility is targeting companies with up to 15,000 employees. It has been technically difficult to set up, but he said that things are about ready to roll out. So a little bit more stimulus there, which will help. All right, let's go ahead and start taking a look at some commodities. So the metals are getting a bid here. I'm going to start with gold. So held support the last time it pulled back. We've kind of gotten range bound here, but a pretty good move up today. It look like a double top to you, or more of a trading range, Mike? What do you think?
I think you got a little bit of both there. You certainly have that, very clear pointed double top up there, but we're still within that range. Haven't broken down below, haven't broken up above. So I think, neutral stance on gold right now, Lee. I think that kind of makes sense. I think people, anticipate that inflation is going to come in sometime into the economy sometime soon, but I don't know what soon is. I just used air parentheses that you didn't see on the that you weren't able to see. So yeah, I mean, I think that's, gold's going to keep playing as we keep opening up the economy. And is it moving too slowly? Is it moving faster? And I think that's, we're going to keep seeing that data all day long. I've been watching some of the data reports that we're getting from Jeff Kleintop in his monthly report he's been putting out, showing how China's opening back up, and are we starting to see bigger growth there than since they were doing no growth for a couple of months. Now is their economy moving because they're a few months ahead of us. I think gold's going to kind of still play around with that until we start to see either inflation or no inflation in the economy. So we'll have to see how that goes. But looks range bound right now, which kind of makes sense.
Yeah, the excitement in the metals market is silver. We've pointed this out, that the gold-silver ratio has been well out of whack. I will take a look at that in a second, but this is the future. That is the flag, Michael.
We love flag patterns, Lee.
Yeah, why don't you explain to our clients what a flag is?
So that flag pattern that you have there, we have a flag is two parallel trend lines. Usually they're moving in the opposite direction of the previous trend, but we have them moving kind of parallel to the previous upward trend up there. And then we have that long pole, and what is that pole bottom at there, Lee? 15.50 to about 18.
Yeah, it's $2.50,
to 18.
right?
$2.50. So as we're making that's a nice move today on gold, up 2.66%, breaking out of that sideways pattern. And when we see that breakout, we would think, hey, maybe this has some room to run those 2.5 points that pole was. So if we go from about 18.25 up to 2.5 points, what do we got that at, Lee? I can't do math anymore, but it'll be about 21.75.
Yeah, we'll probably pause at the old high there, but yeah, you're right. That's certainly the target. Absolutely. Let's take a look at the gold-silver ratio. We told you it was out of whack and it started cracking. We told you to keep your eye on silver. Now, silver is a much higher volatility trade, though, than gold. We'll go here to the gold-silver ratio just so you can see how that is normalizing just a little bit. You can see it was well out of whack. the long-term average is somewhere in the 80s. It's still elevated, but you can see how much it has come down with gold kind of going sideways and silver moving. Let's take a look let's take a look at the mining stocks now in both of those metals since we're talking about it. Let's take a look at uh, these are the silver mining stocks. This is not the ETF for the silver bullion. That's SLV. You can see that looks just like the futures chart. But we've got the silver mining stocks are moving out of a pretty nice pullback. If we put the 20-day moving average there, that is something to certainly keep your eye on if you're managing your risk. But this is a pretty classic setup. Pull back to the 20, hold it, and bounced off of it. Yesterday, we took out the previous day's high. That's often the entry on that trade with the stop underneath the low. First target is the previous high. We take off a little bit, and there you go.
Yeah, I mean that's interesting how earlier this month in May we pushed through those highs, at least on the last 1 year chart right there, from early January and early March. We pushed through those highs, broke out above, then as you just pointed out, pulled back to the 20-day. That 20-day happens to now, what was once resistance for them now becomes support. So that's a nice little entry spot, as you just pointed out there. I'd like to see, continue to keep making some new highs there, but that for the bulls on silver, that's a nice move that you're seeing right there right now, Lee.
Absolutely. I would say don't fight the trend on that one. Let's take a look at the gold miners. Not quite as strong, which makes sense because gold is kind of range bound. I think many traders, you broke the 20-day moving average here, which had acted as pretty good support on the way up. Now you got to see if it can crawl back above it. Right now, it seems to be acting as resistance. And that's pretty common, Mike, right? Support turning into resistance.
Yeah, I mean, I guess to get your ratio back in line, you kind of need this to happen. But if you're a gold bug, puts a little pause in it from the miner's perspective.
Yeah, so I think pretty interesting. If you want momentum, maybe you're better off with the silver miners than the gold miners, at least at the moment. All right, let's take a look at Dr. Copper. Still in an uptrend. Also kind of holding the 20-day moving average. It's a little choppier, but it is at least, I would say, going the same way as the market, which is confirmation. I think I've got a chart here. I want to show you. Yeah, so this is copper versus the S&P. You can see that they generally go in the same direction. What you don't want to see is kind of a divergence, but we don't have that. So the copper is the red line, the S&P is there. Also, if you want to see how they're correlated, let me just do this for you. People say, well, do they really move in tandem a lot? Yes, they do, and we'll show you that. So we'll do the correlation here between the market and copper, and we'll do it for the 1 month rolling periods. Anything over 0 means a positive correlation. You can see most of the time, at least for the last couple of years, it has been a pretty good coincident indicator. So there you go. So at least we're not getting a divergence. We watch copper to see if we get a divergence, but we haven't been getting one. So I'd say that's generally positive. All right, let's look at oil. So there's 2 ways you can look at this chart, right? I've drawn it as a inverse head and shoulders. Other people, and we did break out of that. I would say the other more common way to look at it now, though, is, can we fill the gap? And Mike Zarensky was talking about this yesterday. He said there's really good, resistance at 35. So let me pull that down. That's where he saw resistance. But if you could break through 35 and then, you know, you could really scoot if you could start filling this gap. I'm kind of surprised it is holding up here as well as it is, simply because the last EIA report that came out yesterday showed a huge build, and that was unexpected, but it really didn't sell off yesterday. So I think that's telling you something. When something doesn't go down on bad news, a little bit of strength. I don't know. What do you think?
What do you, I hear exactly what you just said there, Lee. That, you know, and that's an interesting point for, you know, almost everything that we're talking about right now. You know, why would you think that, right? You know, you see an increase in supply, you don't see the market selling off. Is it just looking forward in anticipation that everything, you know, when the world starts to open up, there's just going to be higher consumption of oil, obviously, than there's been over the last couple of months. But from a charting perspective, which is what we're looking at, we're seeing a little bit of, you know, a little resistance right there. But it'll be interesting to see if, you know, oil can continue to the rally that it's had, because it's had some rally over the last couple of weeks.
Yeah.
Maybe it shouldn't have been down as low as it maybe went. But maybe, you know, this is still a big move up from what would we hit 18 and a half, 19, somewhere around there. And now
Yeah.
we're at 33. So it's quite a move for oil. And that's impressive that, you know, when we have a buildup in supply, that oil doesn't necessarily sell off. So we'll have to see how that plays out over the next couple of months.
Yeah, if you're a short-term trader, I would use the 20-day as a stop if, because that's also under these two lows, the last two times it pulled back. If you want to trade it. All right, let us go. I have some, let's, before we talk about the US market, I'm going to show you another chart here.
Go ahead.
All right. This is from the European Commission, okay? And a couple of things. Investors, if you look at fund flows, have been pulling out a lot of money from overseas mutual funds and ETFs because they have such miserable sentiment over there. You can see that the pessimism that is being measured by the economic sentiment indicator there, that ESI, is as bad as it was in 2009. However, it has started turning up. Okay, and there's only this data series has only been around since about 1987. The two other times that we got below 75, which is this level right in here, and then turned up, okay, has been a particularly interesting sign. Again, there's only been two times other than right now that's happened, in 1993 and in 2009. And if you, the tracking stock that you might want to look for is the Euro Stoxx 50. I'll show you the ETF for that in a second. But just look at this. 1 week after that thing turned up, the Euro Stoxx was up both times. 2 weeks later, it was up half the time, but 6 months and a year later, up and up a lot. So I don't know if you're underexposed. This is the ETF for the Euro Stoxx 50. Okay, it also just broke out recently. So if you're underexposed based on that, maybe dabble in it or not, but just kind of interesting, I thought. And right now, of course, you're coming up right to this resistance level. We couldn't get through there, but based on that sentiment reading, you know, this could start moving, especially if it can take out that last bit of resistance. Now this gap's a little bit more because it's obviously based on, you know, foreign markets that open before we do, but I think this is an encouraging chart. But just from a technical standpoint, what do you see here, Mike?
Yeah, listening to your analysis and the correlation that you were drawing on, you know, from that study, yeah, that would look like, you know, right here, like you said, a little bit of resistance. You know, you've shown like there was two times on that chart that, you know, it's turned up tremendously. This does give you the possibility, if we were to break that resistance level, right where you just drew that second blue line at give or take 33.78. There would be some room to run. You know, you get from 33.78, get a little more resistance right around, you know, probably a little bit above 35.50, somewhere around there, it looks like on that chart. But you're above the 20 right now. You know, looks like there could be some room to run. And again, that all makes sense as well, right? As the economy starts to open back up, the employment prospects will get a little bit better, and then you know, the European economies might start moving a little bit more. And it was, you know, the other line on that chart was, you know, it was comparing the economy to the unemployment rate. So I think that it looks like a promising potential trade there. It certainly does.
All right. All right, let's move on to the S&P 500. And I'm going to put up two moving averages. Now, we covered the sentiment data yesterday, but I wanted to give you new sentiment data that just came out.
We always look
All
new
right.
data, Lee.
Yeah, so this was a weekly measure. This is the equity exposure of the National Association of Active Investment Managers, above 80. Okay. Now, so that means they're 80, basically 82% exposed. So the point I want to make is that there's, if you want to these are professionals, theoretically. Um, and theoretically, they know what they're doing. So let's compare them to the AAII survey, the individual investors that we talked about yesterday, that, you know, comes out Wednesday night. They're only 33% bullish. This is one of the widest spreads since the beginning of this study, all right, which started in 2006 of this survey, between the AAI number and this number. It's tempting to think about this as smart money versus dumb money. So let's just look at the data returns, all right? So the spread right now is over 40, right? It's 82 here, 82% exposure versus 33% bulls, which is about, I don't know, what was that, 47?
47ish.
Yeah. So let's look at rate of returns when the spread has been over 40%. The average 1-year forward return on the market was 7.7%. And when when the spread was below zero, in other words, money managers are more negative than individuals, then the forward return is only 1%. So maybe you could say this is a slight positive, for what it's worth.
Maybe you're taking this as a leading indicator that this smart money knows something out there that maybe us as the general retail public doesn't, when you kind of give us this smart money, you know, dumb money kind of commentary. But what I would also say is, you know, maybe that smart money, you know, we've heard that old saying, don't fight the Fed, right? And, you know,
Right.
everything that they've done over the last couple of, you know, since March 16th, March 17th, to fight from an economic standpoint, that everything that the Fed has done, you know, that's where the smart money is getting this feeling. But when you go to the individual investors and you got over 36 million people unemployed, you're probably going to get that lower number from the retail public as well. So the statistics make sense that you're explaining. I understand that. And you're giving us that there, you know, maybe there's some potential with that, you know, a higher upward potential when there's that big spread that you just mentioned, that maybe, hey, the smart money for once is, you know, maybe kind of leading the pack a little bit, right? It's always
Yeah,
food
but
for thought, Lee. Always food for thought.
it is. Now, the regular smart money, dumb money index that we follow and Lizanne follows, she's our chief market strategist if you're new to charting the markets, that is actually neutral. That has actually the dumb money a little bit smarter. It's a different way that they calculate it, but it is not. It's neutral. So you got that smart money, dumb money measure neutral. This is not neutral. So for what it's worth, so it's
Interesting question.
it's a slight edge maybe on the bullish side.
Hey,
All right.
Lee, interesting
Yeah.
question we just got on that though. It says, is this a rear view mirror though? That was one of the questions that we just got right now on that chart that we were just showing. I would not think, I would think that's more of a leading indicator rather than a lagging. I don't know how you would interpret that.
Yeah. That's the wrong chart. Yeah. No, it's showing based on the survey, asking what is your equity exposure. So I mean, it's a real time number. It's not lagging in that sense. And the spread is actually a forward looking indicator based on that data run we did. So I wouldn't say
I
it's,
agree with you.
I wouldn't, yeah.
Just looking at the question that we got, and I kind of agree with you. Yeah, I was hoping we explained it correctly. That's why I came back to you with that. There you go. There you go.
All right. So I'm going to let you just give us some levels here that you see, Mike, and leave it to you. Just to keep in mind, the blue line is the 200-day, the orange is the 20, and the purple is the 50. So what are you seeing here?
Yeah, I mean, I think what we're seeing is something that we've been seeing for the last couple of weeks, right? So, the S&P 500 has made a nice move out, right? Nice move up. We're sitting at 3,014. We're in a short-term period since mid-March of making higher highs and higher lows, so that's a good little trend from us right now. Do I see that an area where we might stop? I think you just had two resistance lines on there, Lee. Is that correct?
Yeah, I can put them back. Let's see.
Yeah, so I mean, we're hovering at that blue 200 before you click that. We're hovering at the 200. We just pushed above, which maybe was a little bit of a resistance earlier in the week. And now we've kind of pulled back down to sit back on the 200. So from a chart perspective, that's great. What did you just draw right there? You just drew that red line on. So again, drawing a little bit of resistance. If you look to the left of the chart, you see last July, last August, that was a resistance level for the market. And what was once resistance when we finally broke out in early November of last year, that became now, once that was a resistance spot, now that became a level of support. We used it in early December as a support level. You can see in March when we kind of had a little bit of dizzying move, we kind of hovered at that same level that we're at right now. So those first couple of days in March, then we fell off of the cliff. Obviously, I don't have to explain that to everybody. And now, amazingly, we have had a dramatic run right back up to this area again. So coincidence? I don't know, but that, obviously that's why we love charts, because it does give us these levels of where we were at I'll call it last summer. Last summer, we were right at these levels. So year over year, the market really has not moved all that much. We've moved, it's been a crazy year, but year over year, from a market perspective, we're kind of in these same levels. So I do like that we have turned above the 50. We're slightly above that 200 right now. I'm sure we're above the 20, wherever you have your 20 on there. I'm sure that 20 is crossed back up over the 50. But we'll still have to see if we can get to a spot. So, we have that 20 cross and over. That's a positive turn. I'll call that late April, early May, right there where your pointer is. I think you're going to need a little bit more news out there on these stocks. We pretty much just ended earnings season. I mean, it was over pretty much 2 weeks ago, but you got the last few stragglers that had started reporting earnings. You had, I think, Costco earlier today or yesterday. So I think right now that the market has priced in quite a recovery. That's my own opinion, that the market has priced in pretty much a good recovery in there. And I think it's just now going to be data dependent. That's kind of, I hate that term, but I don't know what else is going to be able to push this market continued up other than hopes of a good economic recovery, which I'm not in the hopes game. And just, I need to see businesses start opening. I need to see the employment numbers starting to go down. And I think the market's pricing a lot of that in. But this level right here is probably going to be a stalling point right now until we can certainly start to see some good economic news to push this market up. And we've seen that this week. We've seen that this week where the market's just been vacillating up and down a little bit. So my opinion is we're probably going to move a little bit more sideways. I don't think the upside moves or the downside moves are going to be as dramatic as they've been over the last couple of weeks. But that's my thoughts.
All right, we have a client wants to see the weekly chart on the S&P.
I was going to ask you the same thing. I saw that guy's question.
Yeah, so yeah, to your point, if we close, this would be, let me just get rid of everything here. So what our client is mentioning is this candlestick right here. You have a huge uptrend, and then you have one that looks like this, where you've got not too much difference between the open and the close. It's called a spinning top. Often that is a sign that you might stall a little bit. Doesn't mean you have to reverse. It just means that maybe the momentum of the upside is over.
So yeah, he used the term doji there, and that's, spinning top doji, kind of the same thing in a Japanese candle. Small body with a large wick to the top, large wick to the down. Again, this is a weekly chart. And so, as you just pointed out, Lee, that's a great spot. Is, hey, a doji is considered change of trend, but change of trend doesn't mean that we have to go from straight down, which we did a few weeks ago, to straight up, which we've now done. That doesn't mean we have to go straight back down. It just means we can move sideways. And as you pointed out, it was a large move from the down moves of mid-March to where we are now. So if we were to close there, and I can't imagine that we're even if we closed up 200 points, you're just you're not going to make the candle that much bigger. So that's good analysis by Alan in Ohio. Thank you, Alan.
Yep. Now, on the other hand, it doesn't always have to mean that. You can see this is a huge doji this week, and it didn't mean that the trend was over either, the downtrend. So
that's a good.
But
it's so
they don't
line,
always work. It's just yeah, it's just like you go from 50-50 to 48-52. I mean, just a tiny bit of an edge.
But that's it, and that's the fun part about charts. I know you and Kevin talk about that. When you're looking at a chart, if I want to be bullish on the market, I want to find as many things out of 10. I want to find 10 chart items that I can find that are bullish. And then I can make the case for 10 reasons that are just bearish, just like you just did right there, right? So you could, when you're a chartist, you want to have a confluence of events, and you want to find as many things to support your case in either direction, bullish or bearish. And that's that's why you like charts. That's why I love charts. That's why you have a show every day of the week called Charting the Markets, because you're trying to form an opinion, based on past facts to give you a future price indication. So, yeah, excellent. That's a nice little chart there.
All right, let's take a look at the NASDAQ 100. I would be watching the 20-day moving average there for any clues. You can see it's been a wonderful guide. It wouldn't surprise me if we go tag the high there. I mean, look at today's week, and yet it's the NASDAQ is up. This is up 0.2%. When we look, you can see it's the cloud stocks, the software stocks, all of those have been carrying the NASDAQ 100. Remember, there's no financials in the NASDAQ 100 and no energy stocks. So those have been kind of weaker groups. They're in the S&P 500, but they're not in the QQQ. So I think that's why you're seeing the strength. Don't fight the trend is what I would say on this one. But your thoughts, Michael?
No, I saw a couple of weird things. Maybe I think it was like 2 days ago. Market was up 500 points. Not yesterday, but 2 days ago, the market was up 500 points, and the NASDAQ stocks were pretty much unchanged on the day. So I thought maybe NASDAQ was losing a little bit of steam there when the market was up so much, and the NASDAQ didn't participate. But then even like on the day today, the market's down 200 points, and you got the NASDAQ unchanged, right? So if the NASDAQ has had unbelievable strength, you're showing right now, we're looking at, QQQ, which is, as you just pointed out, it doesn't have any financials, doesn't have any energy stocks. It's hard to believe that we have rallied back. I think somebody asked us about a V-shaped recovery. It was one of the questions a little while ago. yeah, we're making that V, and I think again, you know, I think we were joking around before we started the show today, Lee. You know, you're like, hey, it might go, it might just go right on through that. I don't know. I'm not saying you're wrong. I'm not saying I'm right. I think we're at an inflection point right here for the Nasdaq. That is for sure. Does it blow through 237 rather easily and make new all-time highs? You know, some of the stocks that are in this grouping, you know, I'll call them their COVID stocks, right? You know, they're stocks that are geared towards driving the NASDAQ higher. But when you start to think about it, you know, and I was doing some analysis with a couple of clients over the last couple of days, when you get these big players in the NASDAQ, are they going to be able to continue to keep pushing? I'll just use an example of a Netflix. There's nothing wrong with Netflix, but if you haven't subscribed to Netflix when you're stuck at home for 3 months, how much more subscriptions are they going to get going forward? And that makes me look at that resistance line on a stock like when I look at that, when I look at the Qs and I think about a stock like Netflix, which is a key driver in that. I just I'm having a hard time figuring that out. And look at that, Netflix has pulled back a little bit over the last week, but as the Nasdaq keeps going higher, I don't know what stocks are going to continue to keep driving it. I get Amazon. I understand why Amazon's doing well. I understand why some of the cloud-based stocks are doing well. I do get that. But you know, as the economy starts to open back up, maybe some of these stocks start to pull back in. So you might get a weird revision in the market where, you know, the stocks that have been the leaders through this COVID-19 might be pulling back, and other stocks that have been really battered will start to pick themselves up. You know, I saw the airlines up like almost, you know, they had a huge move 2 days ago. Um, Caught me off guard as far as seeing those stocks move. But yeah, the Nasdaq right now, it's been the best part of, you know, in my mind, probably the best part of the market. But as we see those levels, go back to the Qs for real quick and just, you know, wrap my point up. I think, you know, on the Qs, we're just kind of pushing to that level where we're going to get some resistance there, I just think. And for me, better safe than sorry, Lee. If clients were upset how quickly their portfolio went down, you know, you look at these levels up here and you start to say, hey, maybe I can start to lighten some positions. I've gotten a little bit of a rally back. But if you're a bull, you better start hoping that we can just push through 237 pretty much on that Nasdaq, on the Qs right there. That's what I'm looking at, Lee.
Okie dokie. Yeah, you're talking about what might be laggards. Let's take a look at the growth to value chart again. We had a nice rotation into value, which lasted like 2 days. So um, I'll take a look at the S&P growth to values ratio here. So we have had it the last couple of days. I mean, Jeff Kleintop is of the view, he's our chief global investment strategist, that all new bull markets have a change in leadership. And since growth, you can see, has just outperformed value forever, he's saying that maybe value, to your point, will start catching up. I'm not positive I necessarily agree with that totally, but that is certainly a narrative out there. And if you believe it, you know, maybe you would, you know, this is the tracking stock for the value stocks in the S&P 500. And you can compare that to the growth stocks in the S&P 500. You can see the difference. So I don't know.
And again, same thing that we were saying before, you know, everybody's got an opinion in the market. And I do think that, you know, some of these value stocks, whatever you perceive them to be, some of these large cap Nasdaq growth stocks, I mean, it's just the moves they have made, you know, make me think the other way, right? And again, that's what makes the market. Everybody's got an opinion, and we don't have to agree on everything. But you know, those are telling charts right there. The Vanguard growth versus the Vanguard value. That, you know, those are telling charts for me. I see definitely divergence in the groupings of stocks that are driving the market higher right now.
All right, let's take a look at the small caps, then we'll take a sector review. Still flirting with that breakout level. Underperform. I mean, they had a little bit of outperformance over the last week or so. They're giving it back a little bit. It would be better for everybody if it can close kind of back above that 1390 level. Wouldn't you say?
Yeah, listen, certainly above that level because we'll call that a little bit of support. It was an area, if you look to the left in early March, where we kind of gapped down, right? So we're trying to fill that gap, and now we're coming back into the bottom of the gap right now. So I understand exactly what you're saying there, Lee. I also see on the Russell, quite a move certainly in the last week and a half, but I also see that 200-day is just hovering over our
Yeah,
heads right now,
yeah, I
right?
agree with you.
That
Yeah.
the 200-day is going to be a little bit of a resistance. And again, Lee.
Yeah.
Oh, sorry, I thought I hung up on you. Hit my headphones. I apologize. Um, what I was going to say is, it was hitting that 200-day. Once we start to hit that 200-day, that's going to be a little bit of a resistance for the Russell. And we're getting to a period where, from the small cap stocks, you're not really going to be getting a lot of news, right? You just ended the earnings cycle, so we're hitting a hollow 3 months right now. Again, nice move up off the bottom. Certainly nice move up off the bottom. I see the 200 there. Again, I see a little bit of a sideways pattern for a larger part of the market than right now after this gigantic move up. I do see though where you're saying, and I don't want to see this thing start to peak back in and fill the gap that it just created
Right.
over the last week and a half.
Yeah, I don't want to
So
either. We had a
yeah.
question on a lot of tails on the QQQ. Uh, well, that one
Zoom in
is
on
right.
the last couple of days. Yeah, zoom on the last couple of days.
Yeah. Yeah, I mean, I think this is more towards Mike's point, that I think it's shown a little bit of indecision. You go one way, you come back, you go the other way, you come back. That's why you have the tails. Um, Today's just got to do nothing. So probably to Mike's point, that means the momentum is waning a little bit on the upside, I would think. To your point, Mike, that it's going to be a little harder maybe to break through that high. All right, let's take a look at what's going on with the sectors. Let's go to, let's see what's moving today. So I'll do by today's change. Yeah, so gold miners, well, we talked about them. Software, again, technology. So this does not feel like value to me right at the moment. Software, uh, automobiles, that's discretionary. That's a little cyclical. That's probably due to Tesla, maybe. Let's just take a look at the semiconductors, which are up there again. Marvell had earnings. They were tremendous. Yeah, let's run it into resistance too, right? Kind of chopping around in here to your point again, Mike.
Yeah, and listen again. These stocks have had a tremendous move, and again, we're all trying. There a lot of similar chart patterns of filling these gaps right now, right? So we've come right up to where we fell off the face of the earth in the middle of February, and right now we're right at that gap spot, and we're trying to fill that gap. And it's not, listen, I wish it was easy for it to fill the gap and we'd have a bull rally every day of the week. But look at, at the, even where you just drew that, started to draw that line, Lee, you know, yeah, that spot. I'm looking at the bottom of that box that you just drew. We're trying to get in there, but if you look at today's candle, we're still not inside that window. That's what they'll call that. And like for I'm sure you would, as being if we're eternal bulls, if both of us want to be bullish, we got to start seeing us get inside that gray box that you are. And today we are at the bottom end of it, so we're not even in that box. So yeah, again, stocks. I don't think anybody's got a complaint with any of the semiconductors. they have done more than their fair share over the last couple of weeks to help the market rally back. They have been a strong performer. You had an interesting chart though when you were on those sectors. Sort by the 5-day change. You sorted by today's change, but let's take a look where they've been moving over the last 5 days, because there's been a little bit of rotation, I think, in the market.
All right, let me pull that back up. Where is it?
That one.
There it is. All right, we'll do 5-day change. So there you go. That's to your point about laggards picking up a little bit. Aluminum is cyclical.
Yep. Airlines, obviously, you look at the banking stocks, right? So we're seeing stocks in certain indexes that are certain sectors, should I say, certain sectors that have not necessarily been participating as fully in this rally, which if you want the rally to have legs, you need to have some kind of rotation. So it's good to see that other stocks are picking it up. That's again, that's my take on it. But I do like to see that other areas of the market are moving. And while you don't have enough money to buy every stock in the world, right? So you're going to pull some money from some other stocks, from some other areas that maybe have already given you a nice return, and start to rotate into those perceived value areas. But yeah, it's an interesting move out there.
Yeah. And with that, unfortunately, our time is up. We couldn't get to all questions. There's just so many of them. But anyway, coming up next, we have Modern Wealth Strategies, Funding a Retirement Paycheck with Patrick Means and Richard Velasquez. So stay tuned if you are